Okay, testing, 1, 2, 3. Testing, 1, 2, 3. Me. 2, 3. Yeah, there we are. In sooth, I know not why I am so sad. Hey, good morning, everybody. FX Street. Sorry, I know you think it's cigars. It's ghee. I put butter in my coffee. Anyways, good morning, everybody. How are you doing? Yeah, Trade Non-Farm Payrolls Live. This is the 210th month of doing this one webinar at FX Street. If you're trying to add that up, we're getting pretty close to 18 years. 18 years. I found out it wasn't his. So, wow, we got a lot to do today, huh? Yeah, so non-farm payrolls will come out and we will find out whether the market's going to freak out or not. It's one of these behavioral finance issues, I think, going on, in which good news is bad and bad news is good. Dogs living with cats. Yep. So anyways, it's going to get very, 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 very interesting. Now, my name is Wayne McDonell. I've been trading for 20 years. And along the way, I've made tools to help my job and improve my performance. So we will use various tools today, and they will be put on display so you will see them. Some are free, some cost money. Hey, that's the way life works. You got, right? You got no money, you got no car, you got no woman, and there you are. So anyway, we'll try a bunch of things. But I'd like to start by thanking FX Street for the wonderful relationship that I've had with FX Street for, we're getting pretty close to 20 years. 20 years, yeah. Very cool. Before becoming a full-time foreign exchange trader, I started out as a venture capitalist, or actually my last job was as a venture capitalist, which is investing. So I've been a professional investor for a while. I've been a coach to high-tech startup CEOs in the Silicon Valley, helped them raise money. I worked for a few companies you may have heard of, like Apple, Cisco Systems, and the original SpaceX called NASA. Yeah, I worked at NASA. No joke. Cool. I was a rocket surgeon. And then my claim to fame is I also worked on a board of directors when I was in the nonprofit world, and George Soros sat on the board of directors with me. Also, the former president of AT&T, vice president of Arthur Andersen, vice president of General Electric, a representative from the United Nations, and me. So anyways, that's enough about me. I'm an only child, though, so I love talking about me all day long. So how about you? How can I help? We could do technical analysis. We can do fundamental analysis. We could do trader psychology, or we can do all three. Yeah, probably all three is what I expect. Yeah. So right now I have, does this display right? I can't quite see. There we go. I'm trying to fit the chat in there on my screen properly. Fund, please. Oh, you need money? Miller needs money? Oh, money's easy. What you do is you create $100 worth of value and charge $60 for it. You'll have unlimited amounts of $60 opportunities. As long as you produce $100 worth of value, you'll be fine. Jimmy says, hey, can you discuss the bond market? Yeah, you bet. Bonds or treasuries? probably Treasury and particularly yields is what you're talking about. Yeah, I can do that. For some reason, this chat is just not correct. So I'm going to pop this chat out. I can't just fit it on my screen quite properly. So let me do that. Hang on a second. Cool. Treasuries, right. So James says Treasuries, and probably what you're asking about is the dramatic change in yields in Treasuries. Well, in a weird way, it's the market doing the job for the Fed. Okay? Okay? Yeah. So I will be using the Trader's Way MT4 trading platform today. You're welcome to check them out at tradersway.com. You open up a demo account, and I'm telling you, it'll take less than a minute. If you want your charts to look like my charts, then you go to investorbootcamp.com, my trading community. It's a whopping $88 a year, but when you log in, do I even have an account? When you log in, you go to chart toolkit for MT4, MT5. And there's hundreds and hundreds and hundreds of templates and indicators and EAs and all that kind of stuff. But what you do is you just run the installer. Install everything for me, MT4. Install everything for me, MT5. So if you want your charts to look like mine, go to Start at Trader's Way, download MT4, then swing by Investor Bootcamp, become a member. It's $88, includes all the videos, but that. And now, since we're getting ready for non-farm payrolls, we can use another service that I own, and it's QuantBox. So let me get in there. QuantBox, it automates all your macroeconomic research. Our AI-driven data analysis of sentiment, inflation, employment, GDP, technical trends, open trade positioning, and seasonality, and a whole lot more, because QuantBox is expanded, uncovers the best fundamental investment and opportunities. So this will just automate your process. So let me log in. Now, QuantBox is not a website per se. It's a database on the Google Cloud that we've built. So it goes into government and private websites like OECD, the Fed, and others, okay? And it does your research for you. So just a quick snapshot of where we are in the world today. Yields, 10-year, is at 4.72. A couple of days ago it was 4.8, so it's holding. Sharif says, hey, why is gold in a downtrend? Well, it's supposed to be. I'll cover that in a second here, I guess. Oil's all the way down to 82. I'd like to pick it up a little closer to 80. We had it coming down to 85 and then 82. And then I think there's another number. We'll look at that later, I'm sure. S&P 500 holding above 4,200. 4,200 was our number. Euro dollar. Remember, it was way up at 110. Now it's 105. Bitcoin. Okay, flat for the day, but up because remember it was 25. Now we're at 27. Taking a look at longer term gauges, slightly risk off on a weekly basis, slightly risk off on a monthly basis. Nothing too dramatic. To get these daily, weekly, and monthly biases, QuantBox is looking at a basket of yen futures, VIX, the S&P 500, the yield on the 10-year T-note, the dollar index specifically, and gold. So looking at it on a monthly basis, yen futures slightly strong, so it gets no score. VIX is way up, 24% increase in VIX. That's a huge increase in volatility. That's bad. Okay, S&P 500 is down almost 6%. That's bad. Yields on the 10-year T-note are up almost 10%. That's bad. Dollar is strong. That's bad. And gold is down. Well, that's not too bad. Oh, you love the suit? You like it? Huh? Classy, huh? Classy bitch. Yeah. Cool. Thank you, Sky Killer. All right, so anyway, so that's bad, but not terrible. Terrible, not terrible at all, but not good. Okay? Not terrible, but not good. So that's just kind of where we are right now. Let's take a look at the markets, okay, through the lens of a scatter plot. This is showing us here, right now. This is live, baby. So let me get my drawing tool. Oh, I forgot I have to kill it. I have to do this every time. Hang on. Epic pen, kill it. And now I have to start it again. Every time I reboot my machine. All right, here we are. All right. So what we're looking at is QuantBox score on the bottom axis. And then on the vertical axis, we have what has actually happened. Now, this is short term. This is like now, today, intraday. This is not long term. This is intraday. Okay? So that's the first thing. So everything in this quadrant, QuantBox is marked, okay, that could possibly or should be, let's say should, quote unquote, quantitatively, you would expect these things to be up. So that's bad. And QuantBox quantitatively would say everything up here should be down, so that's bad. Okay? So everything this way, okay? Everything this way, you see? QuantBox is bearish on. Everything this way, QuantBox is bullish on. You get it? That's the distinction. So what it is actually doing today, or this morning even, is everything up here has increased in value, everything here has decreased in value. So it's that situation where this is positive, but it should be negative, so that's negative. This is negative, and it's supposed to be negative, so that's positive. This is negative, but it should be positive, so that's negative. And this is positive, right? Expected to be positive, and it is positive, therefore it's positive. Remember learning that? Yeah. And then what you want to do is calculate, a mean. It looks like the mean is about here. Okay, a whopping 0.2. But what you also care about is the slope of the mean. Right? So you're calculating the rise over the run, which is flat. Okay, so there's no trend. Okay, y equals mx plus b. Okay, so m is the slope here, so that's almost 0. X and Y are the axes. B is where it intercepts. That's the intercept, right? And anyways, what we look at this is it's just a flat distribution. There's no trend going on. All of this is expected. All of this is unexpected. Averaged it all out, and you get nothing. Nothing's happening. Okay? Now, inside the good, you see yen is weak, 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 yen is weak. And I'm bullish on all the yen pairs. Yen is weak. Okay? This is what QuantBox is saying, even the pathetic Great British Pound is bullish. I mean, that's what it's saying. Like Quantbox expects it to be bearish, but even that's bullish. All of this was expected to be up, and it is up. So it's just like Quantbox is like, really? Even the pound? Well, it shows you it's very much yen. Okay. Commodity currencies are all over here. Okay. Commodity currencies seem to be weak. Okay, Swissy strong, Swissy strong, Swissy strong. Okay. Swissy strong. So, and Swissy strong here. So Swissy looks like it's strong today. And remember, this is changing throughout the day. This is very sensitive. This isn't long term. This is very much short term. You can take like stock markets out. You could take out cryptos and just look at currencies, and pretty flat. Okay, maybe you only want to look at majors, so on and so forth. And you know, look, euro dollar's up, less right up 0.6. Okay, and the biggest loser is down 0.2. So very much flat, right, for the moment. Now you could like maybe just look at the global stock markets and not a discernible pattern, right? Slightly down, okay, up, up, so whatever. Cool. Okay. All right, Sati wants to know more about the DAX. Okay, well, you go to the global stock market indices and you pull up the DAX. Okay, so why is it neutral? Okay, well, when you look at the labor market interest rates, they're neutral. Then you look at inflation and GDP, in particular the change. That's positive, but the trend is definitely negative. So now that's offset. Then seasonality, you should get ready for it to go up, as you can see right in here. Okay. So seasonality is good, but sentiment and COT data, which is institutional data, is flat. Okay, like for example, you see here, 53% are long, 47% are short, like it's flat. So you add it all up and it's just barely anything. So yeah, so quantitatively, it's more up. So if some of this flipped, like if more people actually bought it, it would turn bullish and then the score would change quite dramatically. Okay. Now, part of this is I don't think I actually have COT data on DAX. I don't even think it's up here. I don't think we have access to that. I don't even know if it gets reported. I guess it would get reported. I'll have to ask the developers if they can pull that in. Just point that out as that's a missing piece. Because, you know, so I can reverse engineer the retail sentiment. Actually, we pulled that in from a service provider, the retail positioning. The institutional positioning I get here from the U.S. government, the Commodities Futures Trading Commission, otherwise known as the CFTC. And that's where I get the other information. And yeah, so I'll see if I can put some DAXI on there for us. Cool. Somebody wanted to know about gold. We can do that in a bit. Like, for example, I guess we can just highlight there. Okay, so one of the questions is, why is gold down? Now, there's still a lot of people long gold, 235,000 contracts. Okay, fine. But look at the shift. There are 2,000 less bulls and 17,000 more bears. So the top, right? So you can see how even though there's more bulls, the bears are coming in. There's less bulls and there's more bears. So this is in the process of shifting from the right to the left. It's still technically bullish, there it is visually, but it's becoming more bearish. So it's the rate of change. How many people think this is awesome information to have at your fingertips? Bernd, it's updated once a week by the CFTC. Okay? So you look at the number of contracts and the change. Okay? New versus old minus old. Okay? Cool. So then you could also look at seasonality. Okay? You change the asset to XAU. And to the person that asked, why is gold down? I would say, well, it's supposed to be. See, it peaks in August and falls in September and October. You see? Peak, down, down. And that's what's happened. The gray line is what's actually happened. And, you know, like, for example, over the last 5 years, gold has rallied in December. Usually it doesn't, but recently it has. Maybe it has to do with monetary policy at the central bank. Oh, thank you, Richard. Okay, thank you for that. So, amazing information, right? A 20-year average, a 5-year average, and what's actually happening. Okay? See, January starts high, but you see how monthly it falls? And that's why it went down. And then you can see March and April and May, gold tends to stabilize, so it did. Okay? And then there's a little dipsy-do going into, you know, okay, because May is higher than June, so, you know, there's your down, okay? And then it rallies back up from a low somewhere around July, peaks out in August, so it did. And then from August, September, October, it's bearish, and it has been. So I would just say to the person that asked about why is gold falling, well, it's supposed to. You just didn't know. Well, you could know. These are facts. This is 20 years worth of data. But let me announce something new. There's a new upgrade. Ha 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 ha. There's a new upgrade. As good as this is, if we expect gold to maybe stabilize and then go up in the next 60 days, we still don't know quite when it's going to happen, right? Which week? Well, as of a few days ago, QuantBox is upgraded to include the week. The week. The weekly seasonality. So we're right here, right now. See the red, the pink or whatever this is this year. So this is where we are in the world today. I guess I should do it pink to be the same, right? This is where we are in the world. Week 40. Okay? And so week by week by week, you see gold tends to top out here and head down. You see that? I'm looking at the bars, the weekly bars. Peaks out and then drops, drops, drops. So what you want to look at now is over the last 10 years, right around here, gold has always peaked out and then really started falling off until 8 weeks from now. Whoa, what? over the last 5 years, gold tends to peak on the 32nd week, which over the last 5 years seems to have, and then drops significantly, and then bottoms out in week 48. So what do you think will happen? This year, we'll down, okay, kind of flattish to down, bottom there, and then go up, right? Up until when? Yeah, baby! Now we're not just saying in January, the first week in January, gold tops out and falls. It did this year, it slightly over the last 5 years, and sort of over the last 20 years. It's good to know. Good to know. Lovely, tell you, mum. Huh? Look at this. You're welcome. You're welcome, everybody. You're welcome. Now, the cool thing is, this only costs us money. Somebody has to build it. So to get there, you got to have 20 years worth of data and do the calculations. But now you know the shape of the gold market. Well, Sky Killer says it's cheap. I priced it affordably, but cheap wouldn't be the right word if you knew what went into building this. But I would say it's valuable. It's a good value. It's like saying, like, look, I got a cheap Lambo. Yeah. Yeah. No, anyways, but somebody had to build it, right? So anyways, awesome. Totally awesome. So that is now on QuantBox Pro. It's live, baby. So somebody asked, why is gold down? Well, it's supposed to be. The only problem is he didn't know. That's the problem. The question isn't, why is gold down? It's more like, why didn't you know it was going to be down? Well, now you know. So anywho, that is that. We have a half an hour to go. I suppose we could do some economic research. And then what I want to do is I want to go through the various employment reports that have led up to this. But we can get a quick state of the world. Let's isolate the United States. Of course, it won't let me. Why won't it let me? There we go. It's jumpy today. All right, let me just manually turn them off. All right. So we have this employment number coming out. And I believe the way that Wall Street is set up is they're set up for a bad number, and a bad number is a good number. Whoa, that's going to get confusing. All right, everybody wants non-farm payrolls to be slightly lower than last month. That's what everybody wants and needs. And I think many institutional investors believe that's FUBAR. So they're ready for a big number, which is a good number because lots of people got jobs. But then that means the economy is not slowing down. Inflation is going to be around longer, and the Fed will probably have to raise higher. So a good number is bad. So what the market wants, and by market I mean like S&P 500, let's say, or even the bond market, they want a number lower than last month, but we don't want negative, you know. We don't want like a crashing economy. We want to know that the Fed has done enough, that one more rate hike is enough. And in fact, the spike in yields in the United States over the last 2 weeks, it's crazy. The bond market's crazy right now. And in a direct way, it's doing the work of the Fed. It might even allow the Fed to not actually raise anymore, but it's priced in that they will. So anyways, a lower number would be ideal. We don't want a negative number, but a bad number would be good. Less people getting jobs is bad, but that means the economy is slowing down but not crashing. Therefore, inflationary pressures could wane. Wink, wink. So, cool. And therefore, the work of the Fed is done. We've found our terminal rate, and things won't get any worse, which is the beginning of things getting better. Okay? Hey, boss, what's up? Hope you have a wonderful day, boss. So, let's start with ISM. Oops, my keyboard's in the way. Here we go. So let's look at PMI, ISM PMI services. Okay. Jim, yeah. All right, so what we want to look at is the employment subcomponent of the service sector as measured by the ISM. So we look over here because we want to look at the rate of change as well. Okay, and we have this. Okay, 53.4. A month earlier, it was 54.7. So the change is slightly down. Okay. Okay, you see that? Slightly down. Okay. But it's growing more slowly, so we're above 50, but it's slowing down. The slowing down is a 4-month trend. And you compare this with manufacturing. There was actually an increase in manufacturing. We went from a contraction to expansion again. But nonetheless, it is slowing down, but not negative. Okay, inventories are growing, but more slowly. Prices are increasing, but not slowing down. Wow. Yeah, so prices are up, inflation. Okay. Look at the drop in new orders. Whoa, 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 whoa. Negative 5.7, that's huge. Okay, way too much inventory. So anyways, things seem to be slowing down, and that might be interpreted by good numbers. All right, cool. So that's the ISM subcomponent. We can go to the Fred, and we can do, I guess we can do unemployment. And then we'll do claims. Well, didn't want to bring it up, so why don't I do claims? Okay, let me isolate this a little bit so we don't get that. Okay, and what we want to see here is a slow uptrend, but we don't have that, do we? So this time last year, okay, more and more people were looking for work, aka losing jobs. And then it's been coming back down. So that's a bit of a headwind. Okay, more and more people are getting jobs, and yet the Fed is trying to slow the economy down. You see the challenge? So that's good news, but that good news is bad news. Okay, let's get back to that unemployment rate. It's weird, it won't open it up. Is it my browser? Yeah, it's my browser. Interesting. A little bit of a lag. Okay, unemployment. We want to see this slowly go up. And, well, unemployment came down as things normalized post-COVID. Then we had this crazy low unemployment rate, 3.5. Remember, with QuantBox, we can compare, okay, like the unemployment rate in Japan's lower than the United States. But what about the unemployment rate in Canada? Higher. Okay. What about the Euro area? Higher. What about in the UK? Higher. Okay. So that's where we see this. We kind of want this to drift a little higher. I don't see like that it really should or could, or I mean, you could argue since what, this bottom in March or April, it's been higher. But yeah, it'd be great if it was over 4. I don't think we'll get that move, but we could. So we want to watch that, because then that would be sort of a new confirmed higher high. And remember, we're trying to get the economy to slow down but not crash. So a slight increase would be welcome. 3.9, 4.0 would be big news. Okay, but when you looked at that weekly stuff, let me go back, and they're not always the same. Okay, like for example, sometimes you'll see more people getting jobs, but the unemployment rate goes up, and that has to do with people entering the workforce, and there's a definition for that. But anyways, this is heading down, so there's no logical reason to assume unemployment will go up. Okay. Now, Sky Killer says the summary of economic projections has one more hike. That is true, and I can show you that here in QuantBox. It's easy when you have all the data in front of you. And you pull up the summary of economic projections. Now, one interesting thing is this dot has changed slightly. This one here, just ever so slight change. Let me zoom in a little bit. Okay, ever so slight change. So this is what shows we're here and we're going to be there. 5.35, 5.43, 5.43, 5.43 down. So according to the Fed, there's one more hike. It's going to happen in the fourth quarter. Then we're going to pause. Then we're going to pause. So 6 months of pausing. And in the third quarter, we're going to cut. The interesting thing is that's not how the market was pricing, but we've known this for a long time. So even smart money can be stupid. Okay? This is the inflation and employment rates in the future. So if you want to know what inflation is projected to be at the end of next year, 18 months from now, okay, it's all here. What will the interest rate be at the end of 2024? Just under 5%. So probably 4.75 to 5.0. Oh my God, 18 months in advance. It's not, well, it is a prediction from the Fed. Yes, Bernd. This is not a quantitative analysis to get this number. This is what the Fed is reporting to us. This is pulled, well, put it this way. The OECD pulls the data from the Fed, and we pull the data from the OECD. It's clever, right? Yeah. So anyways, this is the Fed's projections. They're making decisions based on these numbers. This is what the Fed staff creates. So Bernd says, so it'll change in a few weeks. Well, at SEP meetings, the next one will be December 13th. You have to know these things off the top of your head. Yeah. So they do change, and they should change. Okay? So here we are now. Fed's going to raise, Fed's going to pause, Fed's going to pause, Fed's going to cut, Fed's going to cut. There's the next 18 months in advance. Thank you very much. Holy smokes. Check it out. There's an $8 trial. Even if you hate it, you should sign up for the $8 trial because you get this macroeconomics course that is about 16 hours long. Okay? It's legit. Okay?
Boom. So recently, JP Morgan showed the year-over-year deposits went up by 25% at that bank, the largest bank in the United States. Deposits went up by 25%.
Cool, right? Look at this stuff. Government intervention, monetary policy, and interest rates.
45-degree angle. That's the difference between short-term interest rates paying, let's say, 1%, and long-term interest rates paying you 5%. Okay? Why should
oh my God
invest for 30 years?
Look at this course.
Well, they're taking on more risk.
It's included with the $8 trial. Like, dude, I'm doing all I can for you. All right. So there we go. Enough with that. There's your fundamentals. Oh, I want to do more. Actually, let me bring it back. I wanted to do, so we did weekly jobless claims. We did the unemployment rate. We did ISM services. So we're looking at the trends. Okay. Then what? Why don't we do Challenger, Christmas, and Gray? The Challenger report. All right, September 2023. Yeah. Job cuts fall. Okay. But up significantly from last year. U.S.-based employers announced 47,500 job cuts. Okay? less than last month, but still way above average. Way above average. So that will kind of slow things down, you know? That'll slow things down. It won't be ideally we get a low number. It won't be a significantly low number according to this. According to the ISM services employment subcomponent, it will be a low number, but not a giant low number, slightly low. When you look at unemployment claims, it's not spiking. So things are slowing, but we don't see any dramatic, crash. We don't see a dramatic crash in the employment sector. That's right. We can look at ADP, another dumb prediction, ADP report. Okay, 89,000. What we care about is the trend and changes in private. I guess we're going to say that's okay. So we have a lot of people working in small and medium-sized businesses. So actually, small businesses seem to be doing okay. Larger companies are the ones that are laying off, huh? So anyways, it's a positive number. Showed the slowest pace of growth for a couple of years. So big companies are cutting jobs, which means those people will stop buying stuff from small companies soon, and then they will have to lay off. So once again, this is going up, but at a much slower pace. So what we're hoping, I suppose, is that this indicates that the economy is not crashing, but it is slowing down. But in particular, the slowdown is just the beginning because it's not everybody. Okay, but think of it this way. Think of a Tesla mechanic. Okay, they still have a lot of work. All the Tesla mechanics are hired, they're working, they're fixing things on your Tesla. Cool. But then let's say in the Silicon Valley, high-tech companies, aka large employers, like Oracle, Google, Apple, Facebook, all these guys start laying some workers off. And those workers at some point stop taking their car into Tesla for tune-ups and stuff, if they actually get tune-ups, because, it's expensive and, they've lost their job. So then at some point, the Tesla mechanic gets laid off. There's just not enough work. And it starts to trickle down to the smaller companies. So the mechanic maybe, I'm not talking to a dealer, I'm talking about the shop down the street, they have only 20 employees. That might start becoming a negative number. You know what I mean? So it's trickled down. Okay? See, the way that capitalism works, when rich people get richer, poor people get less poor, because there will always be work, and there'll be more money than people available, so you get compensated a little higher. Now your costs go up, and all that kind of stuff. But the worst case scenario is rich people get poor, and then there's no work for less rich people, and then the less rich people become poor, and everyone ends up poor. By the way, I'm writing a book about how to go from poor to rich and then rich to wealthy. Isn't that interesting? How to go from poor to rich and then rich to wealthy. Oh, it'll be out in probably, next year for sure. But anyways. Main Street Macro, what is that? Under lock and key, I have to pay for that. All right. So anyways. So let me reset everything. So there's Investor Bootcamp, there's Quant Box. I showed you Trader's Way. All right. Yeah, Rad, it won't be very expensive. I want to price it so it's the absolute cheapest. I'm going to price it so I don't make any money. So I don't know what that's ultimately going to be, because if you want to sell books, you gotta play the game. You got to be in the industry, right? I don't mean self-publishing type stuff. I mean, I suppose it is self-publishing, but you still, if you want to become a bestseller, you still have to play the game, which means somebody's got to make money. It just won't be me. But like the bookstores and the online sellers, like there's this huge process where you price it for 30, but Amazon sells it for 20, that kind of stuff. So I'll price it so the industry makes their money, and then I won't make anything. So ultimately the cost might be like, let's say it's $12. So the book will be priced at 20 and sold for 15 kind of thing. So I want to make it that way. My last book, or I should say my first book, what is it, $89? I didn't price it that way, and I certainly didn't get that money. Gee, amazing, right? I made $5. That was an $89 book. But remember, I sold my rights. It's not my book. I only wrote it. I'm only the author of Strategic and Tactical Forex Trading. It's owned by Wiley Publishing. So I wrote the memoir. They gave me some cash. And then when it was done, I earned some royalty. And then it's their book. And then they put it on Amazon.com. And I'm like, wait, what? $89? Like, I didn't know. I never wrote a book before. I thought it'd be 20. Holy crap. Okay. Right on, Rad. Rutowski. I know a Rutowski. That's interesting. Maybe you're the same dude. All right. So we got about 3 minutes till the NFP. Yeah, boy. Hope you're excited. FXStreet. Thank you for being here today. Just a little housekeeping here. Out of respect for our hosts, would you please click the thumbs up button and show FXStreet some respect and some love for hosting us for the 210th month in a row. And also it shows respect for our moderator. She's doing a great job. So maybe show some love, click the thumbs up button. Tell YouTube this is quality content and FXStreet is amazing. That'd be wonderful. Are you a subscriber? Maybe you subscribe too. Okay, I will be doing webinars every Friday now at FXStreet. Every Friday. So if you subscribe, then I will see you every Friday on the FX Street YouTube channel. Yeah. Yeah. So that's cool. Well, 74 people have clicked the thumbs up button, but there's significantly more people watching. Like, how rude. Oh, Wayne, I want to click the thumbs up button, but I'm so tired. Is it beer o'clock? It's getting close. All right, let's get going. Here it comes. Beep. Beep. Oops, didn't mean to do that. Back. Trying to get rid of some of the ads. Come on. Okay, we're getting there. Hang on. My clock on my microwave, I think, is not quite. Oh, is it an 8 or is it a 9? I might be 2 minutes early. Oh, here it is. It's an 8. No, I got it right. For some reason, the power went out in my office yesterday, and I had to reset things. I'm actually a bull, okay, for the stock market. I want the stock market to go up, but there's, is it actually up? Now, Yasho, if you're like, should I buy it or sell it right now? You should stop trading right now if that's the way you think about trading. You're not going to get that from me, and I don't think that's great. I'd rather teach you how to trade, Yasho. The idea of like you're going to buy it or sell it now based on, it just doesn't make any sense. Yeah. Well, Sharif, you'll see it right here. So I guess the answer is yes. All right, we're spinning, everybody. We're spinning. We're spinning. Oh, we're spinning. How quick the market can drop. 336. Oh my God, that's bad. Oh my God, that's bad. Dang. That's how the market was positioned anyways. Oh, that's so bad. No. Oh my God, that is bad. Oh, that's so bad. All right. That makes me sick. Maybe it's just the stupid, lazy government workers. Oh, my God. Oh, that ruined so much. That's bad. All right. Well, we got to price in more rate hikes. That's nasty. What a nasty number. 336. You're kidding me. The problem with the way they calculate the NFP numbers is there's probably going to be a huge revision, but snap, that is nasty. So we got to price in more rate hikes. So let's see if the market's going to freak out. I think the bond market's going to freak out. Boo-ba-doo. All right. So July. Significant increase for July. So yeah, the rate cut, the first one that's being priced in is May. And we already know that that's wrong, and it's going to become more wrong. It should be, we're at 60% by June, but the Fed has said not until September, November. So we'll see if this changes, but the market's still not pricing it in properly. Yeah, we're at 480 now. That's nasty. What a terrible NFP. 330,000 people got a job. That's terrible. How dare they? Wow. Wow. Nasty. Just nasty. Oh, they're currency rates, not yields. Uh, 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 uh. No. Just seeing if FXStreet's got a bond yield T-note or something. I don't know how to change this. Over 6,000 graphs in real time. Cool. I like how it's a graph. It's not a graph, it's a chart. So how do you change the asset? There we go. So they're 6,000, but none of them are bonds. All right. I was trying to see if FXStreet has a bond yield. Does anybody know if there's a bond yield chart on FXStreet? In particular, like a 10-year? I guess I could try TNX, oops. TNX, is it this one? No. Oh, is it under US? Okay, we'll try that. No. No. All right, anyways. Let's move around. Let's see how the market is responding. Let's go. So that's coming down. That's not good. Luckily, I'm hedged, but I'd like to remove that. That definitely brings gold down in a risk-off mode. So kicking off the 4-hour 21 now. We've been locked in there because of non-farm payrolls. This is a price we identified several weeks ago. And now what's happened is gold dropped precipitously. And then we were waiting, and then we were waiting. The 21 caught up, and now it looks like it's going to try to make the lower high, lower low. Okay. Trying to fit this in here. Let me change the time frame slightly. Okay. So we're definitely still on support, but it'd be interesting if it can make a lower low. I mean, you don't want to sell at support. Selling on that 21 would have been ideal, but now it's more like if it makes a lower low, then sell the lower high. So your selling price wouldn't be now, it would be later, like maybe Monday or even Tuesday, and you'll sell it at approximately the same price, but with significantly less risk. Okay. So we're above the predicted number of 21, but we're below the actual 21. We're caught between 21s. My WTI, we're still at 82, but this is my first buying price, is 82, 81 kind of thing. You can see I projected it here back on Monday. So it fell Monday, it fell Tuesday, it fell Wednesday, Thursday, and here we are on Friday, and we're at one of the buying prices. So I said down, okay, and now we're there, and this plausibly could be a buying price. So what you want to see now is a drop, a pullback, maybe a breach of the 21, a pullback up to the 55, a pullback, and then long and gone. Okay? And yeah, I mean, the issue is right now it's falling on this idea that we're going into recession. But apparently we just added 336,000 jobs, obviously not recession. But that forces the Fed to raise interest rates higher to cause the inflation. So we're going to play that bad narrative for a little bit. That's demand destruction. But you want to look at supply side as well when it comes to an actual commodity, okay? So we'll look at here. This is the EIA, the Energy Information Agency. It's a government agency. And you want to go down here and you want to look at I think it's this one. Yep. And we'll open the image here. And let me zoom in. Okay. And you'll see the normal range of oil inventories over the last 2 years, well, it's actually 5 years, but they're showing 2 years, but the average range of 5 years is in here. Okay? All right. So where we are now, right now, is we're about to drop below the extreme low of the 5-year level of inventory. Okay? And a statistician would say, the rise over the run is a negative, sharp negative integer. You're like, whoa, dude, whoa, whoa, whoa. Whoa! Now, how did we save ourselves from a similar situation? The government reached into their strategic petroleum reserve and dumped it on the market, increasing supply. Great. So prices came down. Great. So now what are we going to do if we drop below that pink line? What are we going to do? Tap the SPR again? It's empty. So there's none in in strategic reserve, and there's none in storage. So when you go to Cushing, Oklahoma, for example, oil is placed in storage. Okay, so there it is. There's the storage facility. So this one will open up because you can kind of see inside a little bit. This is a big picture, so it's great. Okay. All right. By the way, if you're interested in learning about the oil industry, I have a 16-hour course on the oil industry. And you will be able to clearly articulate to your friends and to beautiful people you're trying to impress the difference between, like, well, let's say how fracking works versus conventional. I do an entire class, probably 90 minutes on geology. Actually, I probably do 2 lectures on geology. How could you possibly know anything about oil if you don't know anything about geology? So anyways, if you're interested in this stuff, it's terribly, frightfully interesting. But anyways, you see this? Okay, it's empty, right? Here's another empty one. You can kind of see inside. The thing is, the pipes that suck this out, if you're going to use gravity, which you will, the pipes are at the bottom. Okay? So these, see, this creates the pressure. The top creates the pressure. So the top is like a weight, floating, if you will. I don't know if it's actually floating. I don't think so. But let's say floating at the top of the oil. And then as you drain it out, the pressure plus gravity pushes the oil out. Okay, great. Great. So they're empty. The thing is, you can't empty them 100%. Okay? It's just how it works. Okay? Does anybody have a propane tank in their yard? You don't let it go empty. So when it gets to 10% full, okay, you call your propane company. They come out with a truck full of propane, and then they pump it. Where do they pump it? 80%. Why not 100%? Too much pressure. Why not 0? No pressure. Okay? So the problem is right now is, okay, that one's full, right? That one's full. That one's full. That one's full. So what happens is you don't want to drain like one completely empty and then move to the next. You kind of want to take 5% off of one, move to the next, drop that one by 5%, move to the next, drop that, and you just keep dropping them, dropping them, dropping them. And we're now at that level. I guess it's still here, right? No. We're now at that level where they're all very, very low. And they can't go to 0. So, for example, here's another great example. When you think of the Alaska pipeline, okay, here's the pipeline. It's amazing. It's an amazing, one of the most amazing engineering projects of all time. okay, all through Alaska. So this had to do with OPEC and struggles in the Middle East back at, during the Nixon administration. And I blame Nixon for this, but anyways, OPEC created an embargo where they were not selling oil to the West. So the West scrambled for oil, and there was oil in America and in the United Kingdom, but it was too expensive to get and too dangerous to get. It was just easier to just buy it from Saudi Arabia. But anyways, our friends became enemies. They were not selling us oil. So very, very quickly, what America did, well, let's do UK. The UK had oil in the North Sea, but it was very dangerous and very expensive. So it would cost, let's say, $60 a barrel. That's too expensive. Let's say it was $35 a barrel. And you couldn't get, but you could just buy oil from Saudi Arabia for $20. So why would you invest $35 to get oil when you can get it for $20, you see? So suddenly oil went to $60 and $35 seemed pretty decent. So all of a sudden the UK started drilling for oil in the North Sea. And what America did was, well, if oil prices tripled because of the OPEC embargo, then suddenly you want a domestic supply, and there was a lot of oil way up here. That is so incredibly far north that, there's no people, basically. The only reason there's people there is because of the oil, but before that, it was caribou. Not even caribou. Like, it's so far north, it's incredible. Okay? When you go on, Alaska cruises, okay, they go here, and then they go home. I mean, dude, you got to go around the Bering Strait and way up here. I mean, you're talking North Pole kind of stuff. I mean, look at this. Look how far north you are. Okay, I'm here. Like, it's crazy. It's north. It's the top part of Alaska, and most people don't go to Alaska because it's too far north. So anyways, the oil was here, and imagine all of this is ice. So they built this pipeline, and now, right, the oil tankers come by sea to Valdez, load up, and then bring it south. So they had to build this pipeline, and Alaska is a big state. Okay. So my point here is, you see this pipeline? Cool, right? It just goes on and on. Look at the size of it. It goes on and on and on and on and on and on and on forever. Forever. Look, it just goes on and on for thousands of miles. It's crazy. What happens if you turn it off? It would just fall apart. Bloop. See all these little pieces? There's pieces on here, right? You see this? Let me zoom in a little bit. See? Piece, 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 piece. Millions of pieces of steel creating this pipe. If you lower the pressure too much, so if you turned it off, it would just fall apart. Bloop. You'd have a million pieces of steel laying on the ground. You have to keep it at a certain pressure, otherwise it just falls apart. And the same thing when you look at storage facilities. If they get too low, they just stop working. So low inventory is bad. It's really bad. It's more than just prices are going to go up. It's like things break. Okay. Bumpy says, isn't there a dude that drones over to get estimates? Yeah, but I mean, these levels are not secrets. They're published all the time. So I track them all the time. Here's a nice look at them. Okay, you see that it would just fall apart. So just imagine the pressure pushing outward. Listen, right? There's centrifugal and there's centripetal. Well, you're not spinning it, but there's outward. So the pressure is high on the inside and the atmospheric pressure is low on the outside. So it holds all the pieces together. And so you can't just turn this thing off. Okay? Now what they can do is they can block pieces, okay, and add pressure. And then, so you block to the left, you block to the right, you maintain the pressure, you reduce the pressure in the middle, then you can open it up and you can repair whatever needs to be repaired. The other thing too is you need to clean these pipes a lot because they create wax. They get waxy. So there's stuff that there's tools that you push in there that clean that waxy residue out. But anyways, it's an amazing what they did to build this. But you can't turn it off. So imagine, right, if we ever run out of oil or there's nowhere to put it. So if we had the opposite situation, we had nowhere to put the oil because storage was full, then we're in trouble because we can't turn it off. Think of what you'd have to do is pump it back into the ground, but closer to where you want it. So one of the things I'm trying to say here is this precipitous drop we had recently has to do with demand destruction ideas of going into the economy. And now what I've been saying for the last couple of weeks, and you can see, like, I literally have this number. We've been watching this number for days and days and days. Now there might be a move up based on, even if demand slows, there isn't enough oil anyways. Think of it, who cares? Well, your Amazon delivery truck cares. Your Delta Airlines flight to Japan does. Your makeup does. Your fertilizer does. Oh, you eat food? Well, the farmer has to use fertilizer. Where do you think it comes from? Cows? What century are you in? No, it comes from natural gas. Okay? There are still parts of the world, and it's really amazing when you do the research, there's still parts of the world that fertilizes their fields with manure and their prime heating source is from wood. Lucas says that the guys who built that pipeline are tough dudes. Yeah, there's some great documentaries. Yeah, that's, it's one of those examples of like when America was great, like we will get it done no matter what. That was equivalent to like going to the moon. But if anyone takes that trading course, that oil course at Investor Bootcamp, you'll gain a lot of respect. Even if you hate the oil industry, you'll gain a lot of respect about how amazingly difficult it really, truly is to just produce some oil. You will learn that it's like going to the moon. And yet we take it for granted. Like, we don't even know where our food comes from, right? But what about the gasoline for your car? The technology to get the crude oil, clean it all up, blend it all together, crack it and frack it and then crack it, and then produce a usable product out of it, and then get it to you so you can put it in your Ford F-150. The science and the effort, really what I'm talking about, the effort, is extraordinary. And people have no concept. So imagine you're standing in your backyard and you're looking up at the clouds and they're way up there. Wow, look at those beautiful clouds. Now imagine you're under your feet the same distance the clouds are from you. There's oil. But how do you know? You can't see the oil. You can see the clouds. Look, there's clouds. Well, is there oil beneath your feet? Really? How do you know? And would you spend $8 million digging a hole to prove you're right? You better be really, really right. You better be really certain there is oil there. Well, how do you know? How do you prove it? It's extraordinary. And then how do you actually drill down there? How do you get it? Go ahead. How do you get it? Oh my gourd. So the science is incredible. So I'll teach you all about conventional drilling. And then we have to do things like, how do you get that tight oil? Okay. I'll show you horizontal drilling. Let me show you. All right, here's a place in Canada. I'm very familiar. All right, so where's the river? There's the river. All right, so if you go right here, I think it's probably right here. We got to do layers. Okay, where are we? There it is. Billsfield, that's funny. Canadian Energy Museum, never heard of that. Okay. All right, there's the Devon Hospital. So you go down here. Billsfield. Look at look at the picture. I grew up here. Where is it? I'll see it, I suppose, when we go there. You'll find the company, look at this, you'll find the company that invented horizontal drilling. Amazing, huh? Just farms. Where am I? How come I can't find this? Where did I go? It's gone. I was on the wrong road or something. Must have been. Leduc. Wow, I'm way out of the... How did I get there? All right, so Leduc, way out of... Okay, no. Let me do it again. It must be about here on 60. Sorry, I don't know how I got way down there. If I get this wrong, it's because I was here when I was 10. Okay, like, don't yell at me. Is that it? No, those are just trucks. I must have it wrong in my memory. Unless they put a museum there. It's interesting. I don't remember this museum, and it's right here where I think it would be. Anyways, I'm trying to show you there's a tiny little town in Alberta, and in the outskirts of this little town is a small company, and they invented a means. Maybe it's, I just don't remember it right. That's probably correct. But they invented the ability not only to drill down the distance that clouds float above your head, but then turn it and then drill that way. Just incredible. And just a little tiny company. I don't know where it is. This tiny little company changed the entire world. Changed the history of humanity by being able to do that. Now I'm intrigued. How come I can't find it? How do I do this? I wonder if it'll let me. Will it do it? Is that it? Devon Energy Corporation, Sherwood Park. Oh, well, yeah, they've moved. All right, so anyways, they've moved. That's nearby. Yeah, that's nearby. See, there's Devon, there's Sherwood Park. But anyways, there used to be a facility there. So nonetheless, that tiny little company in Canada changed the entire world. Okay? Jim saying we're at 4, yeah, we're on our way to 5.0. Just amazing, isn't it? I want to move that over there. Sorry about that. Okay. Jeffrey says, hey, Wayne, want to know when they say a higher than expected reading should be taken as positive or negative for the dollar. This would be the U.S. index going up, right? Yeah, so you're saying positive or bullish for the USD? Yes. So the dollar index would go up. Yes. So the bad news makes the dollar strong. Where I think you might be confused, where most people in the beginning, what they think is good news makes the dollar go up, and bad news makes the dollar go down. That would make sense, except we're talking about a reserve currency. So that's completely wrong. It's something that you might think. I mean, logically it makes sense, but no. So in this case, the good number for non-farm payrolls is bad because it forces the Fed to do more, and that bad news makes the dollar strong, but it'll make the stock market go down. Right now, we have a giant leap in yields. Okay, so dollar strong versus the euro, dollar strong against Bitcoin. Okay, dollar strong versus gold. And this market's not open yet. Okay, so oil's come down to my number, and it might be time to buy it if you're doing supply side analysis. Very quickly, let's take a look at the daily risk gauge here. Okay, yen is strong. Okay, dollar, let's see, gold flat, S&P 500 flat, Dixie flat. So we haven't priced any of that in yet. Okay, spike in the dollar index, that's bad. Or not dollar, sorry, 10-year yields, that's bad. Increase of VIX today, 6% increase in volatility, that's bad. But that spike in yield, right? Huge. So anyways, WTI might be a buy. I showed you why, supply side. Did you appreciate that overview of the supply side analysis of oil? A small history of how we got oil in Alaska in the first place. A little overview of the actual pipeline and transportation side of it. Was that all right? Okay. Yeah, VIX is going up, bro. All right, so let's look at the S&P 500 on a smaller time frame now. And it stabilized. I can't even grab it. Why won't it let me? Hello? There we go. All right, so now back out to an hourly. And so there's my line. There's my 42, which we put that line there like 2 weeks ago. Okay? Yeah. Let me stretch. So I got to keep it above that line. The method for which I am hedged. So back in the original crash, when was that, post-COVID, I was triple leverage short. So I put money into an ETF of inverse S&P 500 with 3-to-1 leverage. So I took a small portion of my overall portfolio and put it into an actual leverage, triple leverage short. This time I'm not doing that because I don't believe we have the same setup. I don't think we're going to have a big crash. Well, things might change here today. We'll see what happens in the next few days. But I think we survived this. And ultimately, I think we create a triple bottom or an inverse head and shoulders on this S&P 500 chart. So for example, in the next few days, let's say it does this. Let's say, so we had a down and then we had an up. And now let's say NFP brings it down and then we recover. And then next week we get something like that. That's what ideally. So, but I am hedged. I own the NASDAQ. I own the 20-year note. I own the Dow. I own the S&P 500. Okay, so I'm exposed to the upside. And I'm long everything. But what I'm doing is I'm using call options. So I'm writing options. Against this position. So what I'm trying to do is when I collect dividends and I collect option premiums, I'm making money even if the stock market falls. And I don't think it's going to fall 50%. If I did, I'd be best off just getting out or actually shorting. Instead, what I think is we're fairly near a bottom for now, or I need to change my strategy. But I'd like to see it slowly go up as we realize the Fed is actually pretty much done. So I have to be patient, right? So meanwhile, if I think it's going to drop another 10%, it's okay because I'm going to make 10% in that period. Or if it drops 20%, it's okay because I'll also make 10%. It'll drop 20, but I'll make 10, so only lost 10, everyone else lost 20. So relatively, it's okay. But then I do believe the stock market will be up 10 years from now. We'll have a higher high, right? And so I think what will happen is we had some up, and then we had some down, and then we moved sideways for a long time. In that scenario, my net asset value will be stable, but I will earn income. Cool. But it could be years of moving sideways, huh? So that's how I'm trying to handle this. I'll have to change my strategy if we find out that no, this is actually quite bad, and what'll happen is something more like this next year. We're on our way to 3,000. Well, if we're at 4,200, at some point I have to recognize that it might drop to 3,000, so I could change my strategy. I don't want to ride it out that much. And just going back to 2020, okay, that's the COVID low. Okay, that's a 618. Really? I don't want to give up that much because I might only make 20%, but I'll give up 60. Ugh. So I would want to change, right? What I'm hoping is that the market is looking at this and this, and instead of this big lower high, lower low, which is a bearish point of view, that there's actually more bulls than there are bears. So then this new analysis, let me do this in a slightly different pinkish red, okay? In a bullish analysis, they're looking at it like this. And therefore, they're going to fib this way and have a 382, 50%, 618. And therefore, in the near term, we bust out something like this for next year. Capiche? That's right, James. No, but I want dividends and I want derivatives. Yeah, I want a combination of those things. Okay, so I could study things like beta. Okay. And say, well, you have to start with portfolio construction. You have to say, well, what's the goal? What's the point? Okay. I use a major Wall Street firm. I have an institutional account. So, anyways, you have to start with a portfolio, right? You have to decide, well, what is it that you're trying to accomplish? Like, what is the strategy of a hedge fund? A hedge fund doesn't just go out and do anything to make money. You have to declare in your disclosure documents the risks that you're going to take with the client's money. You have to quantify what you do and the risks taken so that the clients are informed. Like, you don't just do anything, you do something. So you have to think, well, what is it that you're trying to do? Okay? Some people believe it's their alpha is to make as much money as you possibly can, right? The more money, the better. Well, reward is a function of risk. And investors find risk bad. They like big money, but they don't like big risk. But now you could start a hedge fund and say, I'm going to create a high risk portfolio that should make a ton of money, but when things go bad, we'll lose a ton of money. But we think we can make a lot of money most of the time. Okay? You could construct that. So that would be your goal. Like, there's a nonprofit that when they advertise, they say they do high risk, leading edge research to cure cancer. So they tell you right away, like, we invest money. So you give them money. They're a nonprofit. And they will invest it into like crazy research, things that most scientists aren't doing to try to find the cure to cancer. So that's their goal. Okay, cool. So what's your goal of your portfolio? Do you want to take a lot of risk and make a lot of money? Well, there are people that do that, and there are times that makes sense. And there are times when clients are looking for that. They're like, well, I want to allocate 2% of my portfolio to some crazy alpha. But what do most institutions want? They want low risk. And most institutions or high net worth or ultra high net individuals, they want a little bit of risk or a managed risk. But what they're really looking for is not high returns because they're already rich. What's the point? Well, I might go from 1 billion to 2 billion. Who cares? It doesn't make a difference, right? So what most people with money care about, see, if you don't have any money, then you want to double and triple what you got. Well, you ain't got anything, so that wouldn't matter either. So to a billionaire, doubling his money by taking a lot of risk doesn't make any sense because the doubling of 1 billion versus 2 billion, your life doesn't change. You don't need twice as many airplanes. The marginal utility of the second plane is pretty low. So, I mean, it doesn't change anything. You don't buy more houses. You don't buy bigger houses. Your $100 million house will do. So but if you had $1 billion and then went poor, oh my God, that'd be horrible, right? So nobody wants that. So you get to a point where if you have something, you don't want to lose it. If you don't have anything, you're willing to risk it all. Your all is nothing. So anyways, going back to this, institutional investors or high net worth individuals, what they want is consistent returns. They want to know if they gave you money, how much are you going to give them next year, in 2 years, in 5 years? If it's a retiree, they want to know with this amount of assets, so a retirement account, how much can they live on every month, month by month by month? So I try to answer that question. So I can give you a rough example. For $1 million, which is a small retirement account, you could probably expect to receive every single month somewhere between $8,000 and $10,000 a month in cash, and not draw down your retirement account. So you're talking about retirement income. So you want low risk, okay, and consistent returns. Okay? And it occurred to me, I did an entire class at Harvard on managing endowments. So, we heard from the Yale endowment. We heard from, I think the Harvard endowment. I think that just makes sense. Who else am I thinking? My professor used to manage the endowment for the Metropolitan Museum of Art in New York City, the Met, the largest arts endowment in the world. I mean, that's why you go to Harvard, right? And then I was given this project where I had to manage the endowment for the Lincoln Center, another big, it's where you go see the symphony and the ballet and stuff like that in New York City. And I went through all their books and stuff like that. And I realized, what they want, low risk where you never lose principal. That's the initial money. So let's say they had $100 million. They're like, do not lose the $100 million. Okay? All right. So with as low risk as possible, how much money can be made? Well, what you want to be able to do is look at it and make very low risk investments. And if you could make 5%, for example, after the fees and all that kind of stuff, with as little risk as possible, then this institution can run a $5 million a year budget. That will pay for rent and salaries and insurance and all the different things required to operate the museum or the ballet or whatever. But the thing is, if you can do it year after year after year after year after year, the money never goes away, this money down here. Now, most institutions, however, okay, their target, let me do this in a different green, their target is 8%. So they look for fund managers like you who can deliver with the lowest risk possible, 8%. 8%. So I thought that if that is good for a museum, an endowment, or a hospital, or a charity, or whatever, wouldn't that work for like real people too? I thought, wouldn't it be cool if you, worked 50 years, saved all your money, saved as much money as possible, and you live on that money that you saved, and 35 years later you die. Okay? And so for 35 years you didn't work. That's a long time. What if you were able to live for 35 years on $10,000 a month? And then when you die, so you're gone, you have all of your money. All of it is still there. All of it. And that goes to your children, it goes to your grandchildren, it goes to your great-great-grandchildren. And it's a significant amount of money that could last forever and change your lineage. It would make a difference. It's how most people become wealthy, is they inherited the money because they had a wicked smart ancestor who created wealth and passed it along for future generations. And if they did a good job teaching, then those future generations will add to the wealth, not decrease the wealth. Your great-grandchildren will have children who will understand money. Your great-great-great-great-great-grandchild that you've never met will live a life of dignity because of what you did. I like that. So there's a challenge, right? So I want to build a portfolio of low beta, which is, right? Or the other way, so that's like, so I'm teaching a stock trading course, by the way, and we just went over sigma. That's a sigma, not a 6. Sigma. You want low sigma. It's a kind of a number like that. There we go. Low sigma, which is volatility, right? So what do you do? What is it? Sigma squared, right? So anyways, you want low volatility. So you can go through the S&P 500, for example, and find, let's say, of the 500, which 250 have the lowest level of volatility. Is that fair? So you want below average volatility. So you can measure it in volatility with sigma, or you can measure it as the stock's beta to the S&P 500. But anyways, you get down to lower volatility. Low volatility is risk, isn't it? Yes. So then of that, then you're like, I want some that pay dividends. So now you might be down to 100. So you have low volatility stocks that pay dividends. Cool. So now you can use that and you can own them. And now you've created your own index, the Wayne 100. Which is now, right, a pool of shares of low volatility stocks traded in the S&P 500. So they're liquid, lower than average volatility, and they pay a dividend. Now I own these assets. Now I have a basket of assets. I've converted cash into an asset. And then this asset is earning income from the dividends. But then I write a derivative and I write an option and sell it to some idiot. That's how options work, by the way. So I go into the market and I write an option and I say, if the S&P 500 or one of these companies goes up 5%, I'll sell it to you at the lower price. Oh, well, at the strike price, 5% higher than it is now. All right, cool. How much risk did I add to my portfolio by writing a derivative? Because remember, I want low risk. Okay, so I found lower risk stocks. I've earned some income, which means if I own 2% in dividends, well, every year I collect 2%. It's like every year my cost basis goes down 2%, right? So I can lose 10% or 2% in the market and still be at break even, you see? And then 2% next year and 2% next year, pretty soon my break even keeps falling. Cool, all right. But when I write this option, I do not increase risk. But you're like, but Wayne, what if the option gets called? Well, I bought these stocks low. So let's say I paid $50 a share and I say, well, right, my average price is 50. And I write an option that says $55. Well, I'll make $5 a share. I didn't lose money. I sold it for a premium, so I collect $1 or something, right? And the market goes up more than 5%. So the person that bought this option from me, they're like, well, give me my shares. Okay. But I give them the shares at $55. I own it for 50 or even less. So it's a limit order. I just took profit and got paid to take profit. But I actually don't want to get out of this. So I got to do my calculations and figure out what's the probability that this goes to $55. What if there was an 87% chance it won't go that high? It'll go up, but not that much. It just never has. And if you measure the current volatility levels and expected volatility in the near future and all this kind of stuff, you do all your crazy math and you're like, there's almost no chance of this actually being worth money. So let's say it goes almost that high, but not that much. Well, I still own it down at 50. Now it's trading at 54, but not 55. The contract expires, because an option is just a contract, worthless, and I get to keep the dollar for free. So then you add it, and it increases the effective dividend yield. Let's say I said 2%. Well, maybe it increases it to 3%. See, I want low volatility because I don't want it to spike. So I'm trying to earn income from the dividend and from the derivative and by buying good, building good portfolios. And now the cool thing is I can take this money and I can reinvest it to buy more shares. See, I'll earn the income, dividends and derivatives from the derivatives, right? Collecting option premiums, even if the market is falling. So if the market is falling and I'm in a growth phase, I take the money I made, the market's dropped 5%, I've made 1%, so I buy 1% more of those shares, but at a 5% lower price, lowering my cost basis, or my break even, if you want to call it that, my break even price for the entire portfolio. And then I do it again. The stock market drops 2% the next month. I make another 1% on my derivatives and dividends. So I buy 1% more at a little bit lower price. And I keep doing this month over month over month. And so we have a 6-month decline, let's say, like something like this, and I'm just buying more on the way down with my free money. And then in a year or 2 or 3, that dip is long since forgotten, and we're making higher highs, but I bought more on the way down with my income. So now, I own more assets. And what I did with that income from the derivatives and from the dividends is I bought more assets. You see? So some people, this is how most people invest. They're like, I bought Apple when it collapsed after COVID, and now it's up 200%. Cool. And then they ride it down, and then they ride it back up, and now they ride it down, and they're still up 180%. But they still own one share. My goal is that over time, I buy more, 2 and 3 and 4 and 5 and 6, 7, 8. So over a year, over let's say 10 years, okay? In 10 years, the value of my assets, let's say have gone up 100%. They've doubled in 10 years. That's the value, the stock prices. But I own, double the amount of shares. Where an average person would just have shares that have doubled in value, I own twice as many shares that have doubled in value. Who's made more money? And how did I do it? Well, I bought 1% more a month. Let's say 10% a year. Every year for 10 years, I bought 10% more with the money I earned from derivatives and the money I earned from dividends. So the stock market goes up and down. You have good years and bad years. And meanwhile, I just keep buying more and more and more and more and more and more and more. I'm buying more. 1% a month, I'm buying more. So in 10 years, I own twice as much assets that have doubled in value. And now, but think of it this way. If I own double the number of assets and I'm using the assets to earn derivatives and dividends, I'm making twice as much money now. Now, it's still 1% relative to the net asset value, but compared to where I started with, I'm now making 2% a month. But the count's grown, so it stays there. But you see where I'm going? And so if I make, let's say, 10% a year no matter what happens, then even if the stock market drops 10%, I haven't lost any money. In fact, I've gotten cash where someone else says, Well, it's down, but I haven't taken the loss. They have this unrealized 10% drop. Well, I'll actually earn cash. So I can hold the cash, I can spend the cash, or I can reinvest the cash at a lower price. And that's what I want to do, because then it lowers my cost basis, right? For the entire portfolio. So therefore, lower risk. I keep lowering my risk, but the secret sauce is you want to own assets. So I don't want the price of my asset to double. Well, actually I do, but I also want to own more assets. So the value of a house is doubled, but it's meaningless unless you sell your house. But then when you sell your house, you're going to buy a new house that has also doubled. So there's no gain. But what if instead of your house doubling, what if it just paid you cash? That's what I want to do. And then you take the cash and you reinvest the cash. Now, when you hit retirement age, now you've grown your account exponentially faster. So now instead of reinvesting the income earned from dividends and derivatives, that's what you live on. So that when you die, you still have your life savings. And you know that's what wealthy families do. You know to go, and this is part of my book, right? To go from poor to rich and then rich to wealthy, there are some massive steps that need to take. There's no sense, I think, living with a lot of money. You live in a giant house, you have fast cars and fancy watches, and then when you die, all that stuff, all that crap is sold at auction, and the money is pissed away. And great, your family had you were rich. Great, good for you. You were an entrepreneur, you were a hustler, you were a Forex trader, and then when you die, there's no money. It's all gone. They sell the jet ski. The jet ski turns to cash. Your grandkids go on vacation to Florida, and 2 weeks later, your life savings are gone. And you're dead. You had no meaning in the world, or at least you've been erased. The value of your life was pissed away with margaritas. I'd like to prevent that. I'd like to change that. So the point of an endowment is that your money lives forever, in perpetuity. Okay? Well, the interesting thing, James, he's trying to figure out all the nuances of it, which is good and bad or whatever. But the thing is, with options and bonds, they're just math. It's just math. So when you do the math on an option, you know very, 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 very quickly the probability of it being called. And if your goal is to hold the position for 20 years, you don't really want it to be called. So you place it at a strike price in which it's very unlikely for it to be called. Now, you might not make any money or much money, but I'm only trying to make 1% a month. So I want it like, let's say 90% chance you're selling somebody a piece of paper that's worthless. Now, you're like, well, that's unethical. Well, you know what? They have reasons and rationale for wanting to have the option. I don't know what their rationale is, but for whatever reason, and it's usually leverage, they want to enter in a contract with you where they can buy it at that higher price somewhere in a certain future. And they're like, dude, that's a great deal. I'm like, okay, cool. Now I write the contract. I write it. I'm like, dude, let's do a deal. If it goes above that price, I'll sell it to you. If it doesn't go that price, you lose a tiny little bit of money, which I get to keep. So they think this is a great deal. For a little bit of money, they have this opportunity. That's what an option is an opportunity. So I'm like, yeah, if it goes above 55, I'll sell it to you for 55. So if it's at 58, I'll sell it to you for 55. They're like, damn, boy. Yeah, I'm like, good deal, right? The only thing is I've done my calculations, and I think there's a 92.3% chance it ain't going to go above 55. But he thinks it's going to 60. Dude, I'll sell it to you for 55 in the future. So anyway, so you want to, like, you got to be just a little bit smarter than everybody else, right? You got to be a little bit smarter than the person you're entering this contract with. I only have to beat one person. So if I have deeper research, I can figure it out where I'm like, there's no way this is going to happen. But if it does happen, I profit anyways. Do you see? That's why it's lower risk. Either way, I will make money. Now, if I make money because it does go to 58 and I have to sell it to them for 55, well, I only paid 50 or 45 or whatever my average price was. And then now unfortunately, I'll just have a bunch of cash, and then I got to redeploy the cash, and that's work. So I don't really want to do that. Are you guys enjoying this conversation, or is it too esoteric? You're like, I don't know what the hell this guy's talking about. I thought we were doing Forex. I like money. Okay? I like everything money. And I need this to go up, so I'm trying to, okay? Yeah. Love it, man. Sweet. This is amazing. Yeah. Okay, good. Yeah. Cool. So I've actually set up a group. I'm going to teach them everything I know about portfolio construction and management. And I have $50,000 in an account at a Wall Street institutional firm. We're going to grow it into $1 million together. I've maxed out the group to, there will be no more than, I think, 25 or 24, I think I said. So there'll be a couple of dozen people. We're going to meet 4 times a year in person. You have to attend at least one. The other times you can attend over your laptop. Now, if you're in Timbuktu and you're like, I want to do this, I just can't come to the United States even once. Okay, but I'm like, if you can, that would be great. Because we're going to meet as a council, and we are going to manage my money, and we are going to grow my account into $1 million. Cool, right? I think we have about 6 people on the council right now. The Council of Investment Advisors, the CIA. It's a part of Investor Bootcamp. We're going to be meeting in Nashville, and I will give I will show everybody what I'm doing and all the positions. I'll explain everything and hand out the prospectus of the different strategies. And then we'll talk about the economy and our expected future outlook for the economy. And then we will balance and reposition and rebalance and redeploy capital of the portfolio based on our future outlook for the next 3 months. We're doing this in Nashville. So we'll look at my portfolio, and based on our economic outlook for the next 3 months, we're going to look at it and say, all right, when you have 5 strategies, 1, 2, 3, 4, oh, my mouse ain't working, 4, 5, and then I come to you and say, well, I'm interested in doing a 6th. Let me explain it. So I have to teach you all the other 5. I don't even know if it's 5. So let's say I have one on the S&P 500. or like I showed you, like Wayne's 100, a version of that. It's not actually the S&P 500, okay? But then I have one on the Dow, which is lower sigma or beta than the S&P 500. Then I have NASDAQ, okay, which has a higher sigma than the S&P 500. I actually have two strategies, I think, on the S&P 500. I have to explain. Then there's, the 20-year note. So bonds, okay? I dumped 99% of that, okay? I dumped 99% of that and split that money between the S&P 500 and the Dow. Why? I felt, and this is not even a joke, 6 weeks ago, the bond market was going to crash. So I decided to move money out of it, 99% of it. I keep it open just so I can see the percentage change. So it's dropped probably 10% since I moved my money out. So I avoided all that. And I moved the money to the S&P 500 and Dow. What do we call that? Rebalancing. Same strategies. Okay? And then, is there another one in here? Okay, well, let me get rid of this one then. And then let's say I do a presentation. I do want to do this in December. So our meeting's in December in Nashville. And I want to introduce one based on the VIX. So look at the diversification I have now. Okay, I'm replicating the S&P 500. I'm replicating the Dow. I'm replicating the NASDAQ. Okay, I'm holding 20-year treasuries. Why? Duration. Duration is the sensitivity of this particular asset to changes in interest rates. Now, in Investor Bootcamp last night, I showed the yield on the entire yield curve from the 3-month to the 30-year and showed this duration that the 20-year is special. Like everybody looked at it and go, oh my God, look at that 20-year yield relative to all the other yields in the yield curve. It was like obvious. Why not the 10? Why not the 30? You could just look at this yield curve analysis that I was teaching and everybody could see it in 1 second. Like, dude, there's something interesting about the 20-year. Yeah, well, okay, I like that. So I'm exposed to that because of the future potential duration, not risk, but duration reward. Okay? And then, right, so by the time we meet in December, we might want to take some of this money and move it back to the 20-year. I might have new cash to put into the 20-year and leave these, right? And then I introduce a new strategy to add to here. So now I'm trading volatility, I'm trading bonds, and I have money invested into high-tech growth, large multinational, and medium to large broad market investments. I'm diversified up the frickin' yin-yang. Okay? Anna says, is a bond crash a problem if you're holding the bond to maturity? No, it's not a problem. Unless, are you ready, Anna? Unless you're using the asset as collateral. And your pension fund is, your insurance company is. So there's this new level of risk where whatever you're leveraging it for, they come back to you and say, Anna, You've pledged your bond as collateral. And the value of this bond is now fallen by 50%. Therefore, Anna, by Monday morning, we need you to double your collateral. Or we sell the collateral you pledged and we remove our money. So if you're a pension fund and the bond market drops by 50%, you need to now double your bond holdings. But wait, you don't have that kind of money. Now it's a problem. Now the bond itself isn't any riskier. It will mature. You will get your money. In particular, if we're talking about government treasuries. But if the value is marked to market somehow because it is being used as collateral, now you're in trouble. And this is what happened to pension funds in the UK last year. The Bank of England jacked up interest rates super fast. The gilt market crashed, and the pension fund industry went insolvent in a matter of a few days. And the Bank of England had to stop what they were doing, and then they had to go back and save their pension fund, their pension industry. Okay? So yeah, it does matter. In a similar fashion, what I'm trying to show you here is if I think the stock market's going to be higher in 10 years, then I'm not so worried about the net asset value. The way to think of net asset value is, what is the value of your house? And a lot of people do this. They're like, dude, my house is up 10%. Dude, my house is up 20%. Dude, my house is up 30%. Dude, my house is up 40%. And then, well, dude, my house is worth 30% more than I paid, but it's cool because it's still worth more. Oh, dude, right? Now your house is only worth 20% more than you paid. But nothing's actually changed, right? You still live in your house. It's not like your mortgage goes up unless, I think like an American. Like, why would you, I still don't understand. Why would you have a variable mortgage on a house when you could get a mortgage for 3%? Why would you not lock that in forever? Well, of course I did. So I'm thinking this way. Now, if you have a variable mortgage and mortgages have gone from 3 to 6 or 3 to 7, and then you don't understand money. But anyways, so now we go back to this concept. Another year goes by. Now it's up 30% again, and then it's up 40% again, and it's up 50% again. Okay? That's the value of this asset. So think of it like your stock portfolio. It can go up, 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 have a bad couple of years, and then go up, 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 and then have a bad couple of years. Okay? And that's volatility. How much it does it and how often it does it and how quickly it does it changes all these different volatility profiles, either known as sigma or beta, depending on what you're measuring. Sigma would be like the stock. No, beta is the stock to the market, and this might be the market. Okay, sigma for the market, beta for the asset. So like, how much does Apple move relative to the NASDAQ? Okay. So anyways, beta is Apple, sigma is the NASDAQ, the volatility of those assets, right? And you're doing comparative analysis. So here's the thing. You can't spend any of this money you made. Therefore, when it falls, it's not real money anyways. And then you made money again because the value, but it's just value, it's not money. So I'm trying to build a portfolio where I actually don't really care. I'm not picking any particular stocks. I'm not trying to beat the market. I'm trying to increase the amount I own of the market. I'm not picking a particular stock. I'm picking broad market stocks. I'm trying to buy all the S&P 500 that's not too volatile and that pays dividend. I want to buy all the Dow because by definition, the sigma of the Dow is extremely low relative to the NASDAQ. I mean, 60% lower volatility. And I like these companies because they pay dividends. And I like them because they're all multinational. It's global. It's not like now I have country risk where I only invest in the United States. They do business everywhere. Low volatility, dividends, and they sell stuff all around the world. I'm diversified. Okay? So look at all this diversification where I'm trying to diversify out risk. So now my risk falls further and further and further. And then I just leverage all this, not really leverage, but use it. Not leverage like pony up and double down. No. I'm just using these assets because now I own assets and I can put them to work. So let's say I have a company, we'll call it XYZ. And let's say it's a company in the Dow. Okay, XYZ Inc. And I own 100 shares of XY Inc. And it's in, what did I say? Let's put it in the S&P 500. Okay? So XYZ sells in the S&P 500. I own 100 shares of this company. And it pays 5% a year in dividends. So therefore, you know it's not a growth company. Okay? It's a mature, old world, boring company. That's why I own it. Cool. So how do I make more money? Remember, I'm trying to make 8%, maybe 10. I can go to my broker, aka market maker, and I can say, lend this out. Okay, lend my shares, that's a lend, to short sellers. Who owns the asset? I do. I own it. I never give it up. I just let people borrow it, but I still own it. So I collect the 5%, no matter what happens. Okay? Yes, they do it, Sky Killer. Sky Killer says he was creating an IBKR account and asked if they can allow it. They do. Yeah. So I own XYZ. I'm the owner. Okay? And the broker, then I contact the broker and I'm like, lend it out. See if anyone is short selling XYZ. So they can borrow borrow it from me. Now they have to pony up collateral. So they'll pony up treasuries, which is a cash equivalent worth 100 shares of XYZ. Okay, so they pony up the cash. It's required. And now they short sell it. Cool. For a week, a month, 2 months, doesn't matter. I'm going to hold it for 20 years. I don't really care. I'm an owner of this asset. I'm not a trader. I'm an owner. Owners are bosses. I'm a boss. So some pissant hedge fund wants to short sell XYZ and pick up a few pennies along the way? Sure. My broker charges them 5%, and I do a deal with the broker. Broker keeps 2%, and I get 3%. And so now I'm earning 8%. Okay? Which is what? 60% increase in income by simply lending it to somebody else. So the stock could drop 8%, and I'm at break even. I haven't lost any money because I gained 8%. But I'm not going to get out. It's an unrealized loss. So in 3 years now, instead of being down 8%, I'll be up 8%. But I collected 8% this year. Then I collected 8% next year. And then on the third year, the stock is up 8%. But I also made 8% there. So now I'm up like 35, 40%. Because I'm wicked smart. And good looking. But the best thing about me is my modesty. Cool. Anybody amazed? Anybody find this stuff amazing? I find it, you know, it's money. It's only money, but you could be very, 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 very smart about money. So I'm trying to lower the risk by 40%. And make the same amount of money. Maybe even a little bit more, but not likely. Because being hedged means you're limiting the upside, but you're also limiting the downside. There's a cost to hedging, right? Oh yeah, Anna, if you only got 20 grand, no, you can't do it. No, not really. No. So that's why I'm writing a book. I want to help people like go from, well, do I even have the image? I think I might even have an image. Hang on, I had one a little bit. Might be on my laptop though. Probably won't find it. April, no, that wouldn't be it. Pictures. Hang on, just searching my computer. Poor. I think it would be in there. Downloads. Poor. It may not actually have a name. All right, let's see if I can view this. Maybe I'll get lucky. I think. Ooh, that's giant. I like when you have things labeled. Oops, PDF 2. No. See if I can find this quickly. If not, no, I'm not going to find it. Anyway, so the book is actually called Poor, Rich, Wealthy. I'll teach you how to do it. It's the kind of stuff where if you were in a rich family, your grandfather or your mother or your father or somebody would have sat down and taught you. But if you come from nothing, then you don't know all these things. These things are secret. Now, I come from nothing, but I'm going to change that. I'm going to change it. You'll never look at money the same way again. All right, so here's what I propose. Or wait, is it over? I have another half an hour, right? All right, let's do this. I think I have a half an hour. I'm going to shift gears here. Go to tradeplans.ai. It's a free service. No money is involved, no advertising involved. You're not going to get email ads for me and stuff like that. This is my service. I paid many thousands of dollars for it, and it's totally free. No monetization whatsoever. Post a trade plan here, and I will review your trade plan 2 minutes from now. So I'm going to take a quick break, and I'll be right back. Where's my streaming software. Cool. I'll be right back. I'll see you in 3 minutes. Post a trade plan. I'll review it. Hey, welcome to TradePlans.ai, where you can get feedback on your trading idea in less than 3 seconds. You fill out the form, you hit submit, and our trade plans will already be in your email account. In fact, when you open it up, you will see that there's a trade plan for daily, for weekly, and monthly. And again, we can do this in less than 3 seconds. Now, how is that even possible? Well, of course, I'm utilizing artificial intelligence. So my name is Wayne McDonell. I've been trading for over 20 years, and I've been teaching artificial intelligence on how to trade. So when you submit a trade plan, we have thousands of candlestick data points in which we can analyze using dozens of algorithms and help you put together trade plans. You can take what you thought with what the artificial intelligence is thinking, and you can compare and contrast. But here's the cool thing. We also track the trade over time so that the machine is learning from your wins and your successes, or in your failures, or its wins and its failures. And the more trade plans you upload and the more trade plans others upload, the better the feedback gets. So give it a try. Fill out the form, post a trade plan, and check your email. There's already 3 different types of trade plans for you to compare and contrast with your own. Try it out. It's awesome. Yeah, it is awesome. Let me know if you posted a trade plan. If not, we can just end the webinar. Time to get serious. Hoo-ha! Huh? Roll up the sleeves? All right, who posted a trade plan? Nobody? Oh, you're still doing it. All right, cool. Okay, when you post a trade plan, it's completely anonymous. Okay? So don't worry if I poo-poo on your trade plan. It's okay. No one will know it's you but you. What do you think? The tie was too much? Too much? I don't know. All right. So we'll get going. Thank you, Denise. All right. From 8 a.m. So nobody posted a new trade plan? Really? You guys are not into this? Really? Man, if I was starting out as a trader to get someone with 20 years experience to review my thoughts, dude, that's worth money. Anyways, whatever. All right, let's get in with it. So this trader wants to buy pound dollar. Okay, so let's take a bigger look. Up, let's do it this way. Okay, consolidation. Up, down, buy. Up, down, buy. Up, down, buy. Up. All right. my thought is this area here, like, okay, I'll agree with it, but I want to make a point where, like, if you see this as, and there's a line here, if you see this as having been serious resistance, I would expect a bigger drop before the rise. That's my only hesitation with it. Okay? Like almost like this where, okay, you do the up. Oh, come on, drawing tool. I keep clicking a different color. There we go. Up. And no, although I understand this, and that makes sense 90% of the time, I think in this situation, it'll hesitate first. Because there's just a lot of people that see that, and it'll happen again here. Where even if you're a bull, you might think, oh, it'll just higher, high, higher, low. No, I think what it would do if you got up there is maybe test the bottom of the range, test the top, and then break. Because they matter. I mean, you see it, so therefore they matter, right? So anyways, yes, but with some hesitation. I don't really like the pound either, but okay. Okay, yeah. I'm not, all right. Let's take a look at here, buying gold. Okay. All right. Let's do it this way. Delete. Oh, and by the way, this process that I'm doing, you should be doing this with all the trade plans posted as well. Nobody knows the feedback you leave, but think of the learning process of looking at other traders' trade plans. You're comparing and contrasting to what you think or what you would do. It'll open your brain in so many different ways because you're thinking and analyzing using different parts of your brain. Now, opening up a demo account, just firing off a bunch of trades, will only make you a bad trader. Demo accounts won't make you a better trader. Unless you're practicing and building positive habits, but we know 95% of people just open an account and fire off a bunch of trades and try to get rich quick. That's why they end up poor or stay poor. So if you're going through and you're practicing, and this is epic, I'm telling you, this is an epic way to practice. Using tradeplans.ai to practice. Oh my God, you're going to improve because you're thinking, you're doing critical analysis, not just sitting there firing off a bunch of trades because you're bored. Okay? But anyways, this trader says up. Here's my problem with this. It's counter trend. I don't like counter trend. So I would rather this trader would prepare a sell up in here than a buy. So the way I look at this, this is the primary and this is the secondary line. The secondary is a guess of how low the next low will be. So you could just get rid of it. It's nice to see it, but I'd get rid of it. Also, like my price action pivot points are here and some other pivot points are there. This is all bearish, but this trader is buying. So I don't like it. Now, I get it. I understand it. I get it. But I don't agree with it. This trader will probably make money, but it doesn't mean I have to agree with it. Okay. Ronald says he doesn't trust the AI yet. Well, the AI only analyzes candlestick data. So it's not going to track you down and kill you while you sleep. Okay? So if you posted like, oh, selling euro pound, it doesn't have charts. Like, I don't pay money to a charting company to then create a chart for euro pound. What I pay money for is I have hundreds of thousands of candlestick data for euro pound. Hundreds of thousands of candlesticks. Just the data. For the AI, it just looks like a spreadsheet. It's really terrible. To a human, I'll show it to you and it's just nothing. You're like, this doesn't mean anything. To a machine, okay, it thinks, it can do all the calculations. And so when you get feedback from Aiden, our AI, he generates the chart that he sends you on 3 different time frames. And he's doing all these different calculations just to show you like technical analysis, basically. Okay? But it doesn't do anything else. So it just understands that you might say selling euro pound, and he might say, well, technically that's a really dumb idea. Now, to prevent your feelings from being hurt, you're emailed the feedback. It's not posted anywhere. It doesn't go anywhere on the website. Nothing. It's just private. So anyways, let's get back to this. This trader is selling euro pound. Let's talk about it. Let's talk about it. Let's talk about trades, baby. Let's talk about you and me. Let's talk about all the good trades and the bad trades that may be. Let's talk about trades. Let's talk about trades. Let's talk about trades. All right, so I see what they're doing. Yeah, I'm good with that. Where they might lose money is the higher time frame. And a higher time frame trader, let's do this in purple. A higher time frame trader probably would look at it like this. So, but it still works out. Yeah. Like, I'm okay. I'm okay with that. Sure. Le flé to your mum. So someone already had agreed and one person disagreed. Thank you, everybody. That's how you're supposed to be doing this. See, the interesting thing is privately, when you go into your history, so I posted this trade plan and 5 people agreed with it and no one disagreed. That's just private. Only I know that. So imagine that being added. Very cool. And I think I already did that one. That one's from a while. All right, so let's go to the newer trade plans. Thank everyone for posting. Yeah? What do you think about the sign-up process? Super ridiculously easy, right? It kind of confused people at first. They're like, dude, this is so easy. Like, I know. Oh, look at that. Brand new. See, the page didn't even refresh. Cool. Well, we'll get back to that one. Let's start. That's the one we already did, right? No. We did that one. All right. So this is from, 10-12. All right, cool. Oh, I forgot to look. What's the trade plan? This trader is buying euro dollar. Let's take a look. No, I'm going to disagree with this one. And let me explain why I disagree. I'm a trend trader, so I want to kick off the moving averages. So what I would do if I were me is down, 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 up, up, sell, down, 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 down. Okay, role reversal. Up, up, sell. Right? sell there, down, right? Down, 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 roll reversal, up, up, sell. Down, 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 up, up, roll reversal, out. Okay? This is the reset off the neutral zone. And what seems to be happening is the down, 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 and the future moving averages off of this roll reversal smells like down to me. So you're saying down to the 618 and up. Well, then the way to draw this to be more precise is at the 618, it would have to do, okay, and that you're looking at it this way. And what you're showing me here is hopeful, but like, do I understand this part? Yeah, but how do you know it doesn't double bottom and go up? And you don't. So you would have to draw this higher high, higher low, higher high, higher low scenario, in which this is a higher low to that. But the way this is presented, no, I'm going to have to disagree with it. All right, this trader is buying pound dollar. Let's take a look at what they got going there. Higher low, higher high, higher low. Okay, so they have a fib going, but it's not a trend. Yeah, like I don't know what this means. That, I guess. So we have a higher high, higher low, buy, higher high, higher low, buy, high, low, 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 low. No. Did they put in a real price? 121.55. No, it's middle of the range. No, like, dude, we have this, and we have this, and you're in the middle of the range. So bulls buy low, bears sell high. This is in the middle. And this Fibonacci is a trend study inside of a range. No, I disagree with that. That's not very good technical analysis. Applying a trend trading strategy in a range trade, buying in the middle instead of the bottom, or selling at the top. So no, don't like it at all. Sorry. Oh, I forget. This trader is selling USD yen. All right. There's yield curve control. Like, I don't know who's doing this, of course, but I'm like, really? You're going to fight the Bank of Japan? All right, I guess so. And you're also going to fight seasonality, right? And like, So yeah, fundamentally, I don't understand this trade, but let's go with it. Because, yeah, it could work for sure. Okay, up, 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 down, down, up, 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 lower, low. So that's the part I think is going on here. So lower high, and now they're going to do a roll reversal off of a shoulder. And I see that they're in already and a little lower than that shoulder, and that's because they're deploying a negative neckline. So I don't know why they're not in a little earlier. Maybe I didn't do that neckline right. Yeah, I guess so. They're doing the neckline properly. All right. I don't love it. And it's too early, I think. It's a 4H and a sell. Yeah, I guess 49.50 midpoint. Like, I don't understand. Like, I get strategically. Strategically, this makes sense. This is called a crown pattern. So I think they understand what they're doing. They're trading a crown pattern. But I don't like the tactics. It seems like they threw down a trade based on the pattern, and I hate that. Okay. So strategically, that makes sense, but tactically, I don't think this was well done. What'll probably happen if this trade plan comes to fruition is something like that. I would have liked to have seen, in particular on a smaller time frame, because I don't think it occurred, on a 15-minute chart or a 5-minute chart. I want to see a double top, higher high, higher low, and knowing how candles work and stuff like that. It didn't happen in there. If it did, it's still quite aggressive. So, but strategically, yes. Tactically, no. And then fundamentally, I just don't think the yen's going to get strong. So they think the dollar's going to get really weak. I would suggest that it does this. I don't think there's enough wrong with it for me to disagree without it being me just having an opinion. I'm trying to not just have opinions. So I'm going to begrudgingly agree with it. Strategically, it makes sense. And I also know there's a psychological level right here. So is there a high possibility of this? I would say yes, but I'm telling you, even though this strategically makes sense, if that works, there's probably 9 better trades than this one, where I think the expected return, remember that's a mathematical calculation, the expected return is actually flat, I would say. And that if you get this down, something else would move a lot more. Like this wouldn't be the right trade, wouldn't be the best trade. I don't like the tactical entry, but strategically I understand, and it's well thought out of and well set up. But to me, it seems like somebody's trading some pattern and they don't otherwise know what's going on. So I'm going to agree technically, but there needs to be some improvement. Oh, I was going to do one more, but it is 10:30 on the nose, and that is the end of our webinar. So my name is Wayne McDonell. I was your guide on this journey we called Forex. We gathered some data from the Federal Reserve Bank, from the ISM. We looked at a bunch of other things. The Challenger Christmas in Gray. Pre-numbered. Then we got the number. Okay, great. We had discussions on portfolio construction and management and a little bit on derivatives. Cool. I went through a bunch of charts doing technical analysis. So I hope all of that was worth a thumbs up and maybe a comment on the recording to show YouTube this was quality. Also, out of respect for FXStreet for being our host, when I stop streaming and this becomes a video on YouTube, would you just leave a thank you comment? There should be hundreds and hundreds of thank yous under this video. Not for me, to FXStreet. Maybe for me for wearing a tie, for crying out loud. Have you ever done a 3-hour presentation wearing a tie? You know what I'm talking about. So that would be great if you could do all of that. Again, places to find me, tradeplans.ai is totally for free. QuantBox costs some money, but there's a cheap trial. If you want to organize your thoughts so you can have a COT report that looks like that, or like, for example, organizing your thoughts, all the things you want to buy, all the things you're looking at, and all the things you want to sell, it's all beautifully organized. $8 gets you that the course. Remember that macroeconomics course? It's worth hundreds of dollars. You get that with the $8 trial. You'll find me at Investor Bootcamp. We do great work there. It's really good, I'm telling you. Not just the training good, but the community where we get together, like yesterday's swing trading group and stuff. We have amazing meetings. Amazing. I'm telling you, it makes a huge difference. And you might need a broker. Go to tradersway.com. These are all resources I either built or recommend. But of course, the best of them all, FX Street. Today I used their economic calendar, and it's awesome, isn't it? So I've been recommending and using FX Street for about 20 years, almost exactly 20 years. So if I've been recommending it for 20 years, and it's been around for 20 years, and I've been around 20 years, boy, oh boy, it must be good. So peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend, and I'll see you around.